So if you're stuck in rental after rental and afraid you can't afford to buy ever, let me show you what to do. It worked for me before I even became a realtor and at a time when I knew nothing about real estate. And it changes your life. This isn't some real estate investment scheme or one of those investor videos that just tells you to go buy a rental property. It's about the strategy behind it. So you make money, but also so you don't make a mistake. You do not have to be a professional investor to do this, but the process is very specific. And if you're worried that it's complicated, don't. I'm going to walk you through it and how it happened for me. And down below in the description, I created a free resource for you that explains it all. So check that out. And please do hit subscribe because there will be lots more free resources for you to come. So my husband and I have been renting for years, and we were super tired of being tenants, of rent increases, not being in control of our housing, and definitely tired of making our landlords rich. So we were done renting. But when we started looking for a little starter home, we had major sticker shock. We didn't have a lot of savings. We didn't realize how big the monthly payments would be. And even if we could make those payments, there'd be nothing left over for home improvements or living. So every house that we looked at in our price range was either tiny or in a really bad location or it needed too much work. So then we stumbled upon house hacking, but it only works if you do it right. And that's what I'm going to show you in this video. How to afford to buy, even if you have very little money saved, and make money while you're doing it. So I know because I did it myself, but I also have a whole other video on how to buy in general when prices are too high and out of control. So check that one out at the end of this video. So let me begin real quick by laying out a few facts. Did you know that it's a real statistic that homeowners have on average 40 times the wealth of renters? According to the Federal Reserve, the average homeowner's net worth is $400,000, and the average net worth of a renter is only $10,000. But it's not just about owning, it's about what you own. There are a lot of reasons for this, but basically, the big picture is that when you own, with each mortgage payment you make, you own more and more of the house, and you have less and less debt. And yes, I know the value of homes can go down, but values have never in history gone down and stayed down, ever. So the idea is that if you own it for many years, the value will have gone up, and in some cases by tens and even hundreds of thousands of dollars, while your debt is going down. So that's real money coming back to you. So renting or buying, you have to live somewhere and make payments to someone, so it might as well be to yourself. Rent does absolutely nothing to contribute to your wealth and gives you absolutely no long-term financial gain. The money goes right out the window and never comes back, making your landlord rich. And you have nothing to show for it after years of making pretty big regular payments. So real estate grows in value on average about 3 to 5% per year. And it also gives you financial stability because it's predictable. Rents can go up, but if you have a fixed mortgage payment, that means you got a loan with a fixed interest rate. The principal and interest portion of the payment stays the same for as many as 30 years. And they're even talking about creating a 50-year mortgage. I may do a video on that. But of all the paths to wealth, owning an income-producing property, but living in it at first, is the most powerful, by far. I'm talking about a multifamily house or small building with 2 to 4 apartments under one roof. So investment properties used to be mostly for professional investors, and that's all changed now. The secret is out on the power of passive income, and millions of people are snatching up income-producing properties all over the world. But the really smart ones make it their primary residence for the first year or so. Okay, first, can you afford a 2, 3, or 4 family home? So if you're concerned it's too expensive and you won't qualify for a bigger loan, think again. I'll show you the math. But if the rental and maintenance numbers add up, you'll get the loan because the bank will see 2 streams of income, one from your day job, that's active income, and the other from your tenants, that's passive income. And the down payment can be quite low if you're occupying it. And by the way, the IRS defines passive income as money that comes to you from an investment in either a rental property or a business in which you do not, quote, materially participate. In other words, you don't have to do much to collect the income. So on loans with an FHA loan, you can often put down as little as 3.5%, provided you actually live in one of the units as your primary residence for a minimum period of time. And now even with regular conventional loans, some lenders may allow down payments well below the old threshold when the owner occupancy is bona fide, and that can be maybe even as low as 5% down. So a quick but very important note, most loans will have an owner occupancy clause that requires you to live in the property as a primary residence for usually at least 12 months. Year goes by fast. It's just important to check the loan terms and confirm with your lender. So I have 5 easy questions for you to ask when buying the right multifamily, and I'm going to get to that. But now let's do the math. And it's relatively easy, but it's extremely important. So the math basically comes down to 3 numbers, and if the numbers work, then you should buy it. It's basically gross income minus expenses equals net income. But more specifically, gross operating income, or GOI, is the total rental income on the property before expenses. So how much rent can you expect to get if you were not living there? Because you won't be forever. So this should be provided to you before you buy it by the seller, the listing agency, or because one of the units is already rented out, so you'll know for sure what you can get. So if there are 2 units that would rent for $1,300 each, then the monthly rent is $2,600. To get GOI, you multiply $2,600 by 12 months, and your gross operating income is $31,200. Now next is total operating expenses. They are what it costs annually to cover maintenance and repairs, utilities, insurance and taxes, but not the mortgage payment. And that's TOE. So let's say the TOE expenses total $12,000 a year. So the net operating income is what you get when you subtract the expenses from the gross income. So $31,200 minus $12,000 of expenses, that leaves you with a net operating income of $19,200. So this means that you have $19,200 each year to apply to the mortgage payments. So if your mortgage payment is, say, $1,250 a month or $15,000 a year, then you have an annual positive cash flow or profit of $4,200. If you divide $4,200 by 12 months, that's an extra $350 per month that you can use to pay the mortgage and reduce your part of the rent to $950, and you own the building. So what's the mistake that we made? We sold it 2 years later to fund a renovation on the single family home that we were able to save for, which I'll explain in a minute. But the key is to keep the 2 family for like 10, even 20 years and watch it grow in massive value for a college education or retirement, or to build a little real estate empire. Now mind you, the plan still worked like a charm for me. We were able to save money fast by having a tenant, and we still made a massive profit when we sold well over $100,000 because the market had been going up. But if we kept it for 10 to 15 years, we would have made around $1 million. So that's a big regret I have. So my recommendation is don't sell the 2 family, hang on to it, especially because the new tenant replacing you will be paying full market rent. That allows the property to completely pay for itself. If you keep it for 10 or more years, it's going to be worth an awful lot of money, especially as real estate goes up in value over time. Okay, so I'm going to get to the 5 things to look out for when you are shopping for a 2, 3, or 4 family home in a minute. But a word on tenants. It's obviously important to keep the other unit or units rented so your cash flow is steady. You may buy the multifamily vacant or with tenants already renting the other units, but either way, you need good, responsible tenants. This can be a bit of an annual chore if you don't luck out with great long-term tenants who stay for a few years. However, a real estate agency can advertise your rental and screen good candidates for you, draw up the leases, and get background checks performed. And in some areas, the tenant pays the real estate commission for rentals, so you may be able to get these real estate services for free. And if this is the case, then it's truly a great thing because a professional will take the task entirely off your plate at no expense to you. So if you need to find tenants on your own, it's a little harder. You will need to list the rental on the MLSs, respond to inquiries, screen tenants yourself, which takes time out of your day. So here's what you ask prospective tenants: a reference letter from a past landlord, proof of employment, proof of income in the form of a recent pay stub or a letter from the company that the tenant works for, and then a credit check. You may even want to do a background check, but there are a lot of online services who do this for under $50, and you can even charge the tenant for this. But again, if a real estate agency is involved, this can all be done for you. Now, as the landlord, you still need to collect rent each month and be responsive to tenants' needs in terms of repairs and problems. And some tenants can be troublesome if they're noisy, if they don't follow rules, or God forbid, don't pay their rent on time. So there are stressors, indeed. So let's get to the 5 questions to ask when you're shopping for the right property. So whether you're buying a multifamily or any income-producing property, every question is to maximize the rent that you can get from tenants. So ask yourself, what amenities would you pay a little extra for if you were a tenant. So walkability to public transportation and shops. 78% of Americans say they'd pay a premium for walkability, but to a bus, a train station, a trolley, shops, anything like that. For tenants that have a car, is there parking? Especially if you're in an inner city, that's huge. The third thing is there a laundry room on the premises, or would the tenants have to go to a laundromat? You know, it's not that expensive to put a washer dryer in the basement, but it does make a huge difference in how much tenants will pay. Are there separate entrances, which is definitely a premium for tenants, but also while you're living there, and even future tenants, it's nice to have privacy and have your own entrance. And finally, is there any kind of a yard or even a porch somewhere where they can then hang out? That adds value too. So the next thing is, should you buy and live in a multifamily property? So here's the thing, owning a multifamily, it's not very different from owning a home in terms of maintaining it, paying property taxes, and the monthly mortgage. You'll have those same responsibilities whether you buy a single family or a multifamily, but there are two major differences. The big difference is that the major portion of those expenses will be covered by the rent you collect. And the second big difference is that you'll actually be a landlord. So it's not hard to learn how to become a landlord, but it does require consistent time and attention. And some months are super easy and you won't have to lift a finger and the checks just come pouring in. But in other months it may feel like a part-time job, taking a few hours of your time to deal with tasks and troubleshoot problems. And bonus tip, when you file your taxes, you can write off a potentially large portion of your annual profit using something called depreciation as a legally allowable expense. This is a tax law that allows you to offset income from the investment property each year that you own it by claiming wear and tear and physical deterioration of the property. So consult your tax accountant for specifics, but this is a commonly known tax loophole. So good luck, and please hit subscribe, and don't forget the free resource in the description below, and check out my other video on how to afford a home when prices are out of control. I'll see you next time.